You're listening to Peter Lewis's Money Talk.
Good morning, this is Peter Lewis, welcoming you to my Money Talk podcast for Monday the 27th of March. In the headlines today, a slide in the shares of Deutsche Bank on Friday reignited worries over the health of the banking sector. Shares in Germany's Deutsche Bank fell by 14% at one point, with other lenders also seeing big losses. Germany's Chancellor Olaf Scholz sought to shore up confidence in the country's biggest bank and rejected comparisons between Deutsche Bank and Credit Suisse. Deposits at US lenders have posted the biggest decline in nearly a year, caused almost entirely by a rush to withdraw funds from smaller institutions. Deposits at small banks fell by $120 billion, the largest outflows on record, while those at the 25 largest financial firms rose almost $67 billion. Many depositors poured cash into higher-yielding money market funds. More than $117 billion flowed into those accounts in the week ended March the 22nd. Traders in the Fed funds futures markets have abandoned wagers that the Fed will raise interest rates in May and June, and added to bets that its next shift will be a rate cut as early as July. Swap rates, linked to policy meeting dates, now show cuts totalling about 1 percentage point by year-end, and year-end rate expectations are now a stunning 150 basis points lower than what the Fed expects. On today's programme, I'm joined by Alex Wong, Director at Alex Wong Asset Management, and Louis Kuijs, Chief Asia Economist at S&P Global Ratings. With a view from mainland China is Ben Cavender, Managing Director at the China Market Research Group. US stocks rebounded from early losses on Friday. The day began with fears that the banking crisis was spilling over to Deutsche Bank before European officials gave reassuring commentary that the banking sector was safe and lenders were healthy. The S&P 500 slid 1% in the first hour of trading before snapping back and notching its second straight week of gains. It closed Friday's session 0.6% higher at 3,971. It added 1.4% over the last 5 trading days. The Nasdaq Composite Index ticked up 0.33% to 11,824, giving it a winning week with gains of 1.7%. Regional banking stocks helped the market bounce back on Friday. The KBW Nasdaq Regional Banking Index closed 2.6% higher and was up 0.6% over the week. But that masked a lot of damage under the surface. First Republic Bank fell once again, closing 1.4% lower and extending this year's rout to 90%. European markets had a roller coaster week. They rallied off their lows following the Credit Suisse bailout, but then reversed to end Friday weaker as Deutsche Bank's credit default swaps exploded higher. The Pan-European Stoxx 600 index tumbled 1.4% Friday, but was up 0.9% over the week. Asia-Pacific markets were lower on Friday as concerns over the banking sector weighed on sentiment. In Hong Kong, the Hang Seng dropped 134 points, or 0.7%, to 19,920. For the week, the city's benchmark was up 2%, and that's the first back-to-back weekly gain since January. Hong Kong banks slid on Friday, with HSBC one of the largest losers on the Hang Seng Index, closing almost 3% lower. Standard Chartered was down 2.7%. And it looks like Hong Kong stocks are going to open lower this morning. Futures are pointing to declines of around 138 points, or 0.7%, when the new trading week starts. And in the bond markets, the 10-year US Treasury yield fell 3 basis points to 3.37%, declining for 3 consecutive weeks. The 2-year yield fell 4 basis points to 3.77%. That's its lowest level in almost 7 months. And for the 11th consecutive session through until Thursday, 2-year Treasury yields moved more than 10 basis points a day. That's a run of wild swings not seen since 1981. And you can get more details on the latest market movements on my daily blog at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
And let's go and join our guests. We have with us Alex Wong, Director of Alex Wong Asset Management, and Louis Kuijs, who is Chief Asia Economist at S&P Global Ratings. A very good morning to you both.
Good morning, Peter.
So we saw a slide in the shares of Deutsche Bank on Friday, and that's reignited worries again about the health of the banking sector. Shares of Deutsche Bank down 14% at one stage. Germany's Chancellor Olaf Scholz sought to shore up confidence in the country's biggest bank. He said at a summit in Brussels, after being asked if the lender was the next Credit Suisse, he said Deutsche Bank has fundamentally modernised and reorganised its business and is a very profitable bank. There's no reason to be concerned about it. So, Alex, over the past fortnight, we've watched now as 3 mid-sized American banks failed. Then Credit Suisse suffered a run that ended with its forced takeover by UBS. Now the vultures are circling Deutsche Bank. Are they right to be concerned at all about Deutsche Bank?
I think for the health of Deutsche Bank, I'm a little bit confident. But for the banking shares, I think it is still it would still be under pressure because I think people would devalue the whole banking sectors in the stock market. But I don't think the bank run will extend to many banks. So basically, this is a Wall Street crisis for banks rather than a Main Street crisis. I think because. What had happened in the past 2 weeks, I think, has already stabilized the bank run worry. But investors actually would devalue the whole banking sectors, and that devaluation, I think, will last forever.
Why is it that the authorities are injecting billions of dollars into banks? I mean, First Republic Bank has had, $30 billion now injected into it, but it still keeps on sliding. It doesn't seem to stop the slide in the bank shares.
Oh, because it highlights the low transparency of banking stocks. We don't know much about the balance sheet strength from an outsider. And it is all about confidence, because if you do not inject enough liquidities, actually depositors would be quite worried. And no banks actually can survive a very abrupt bank run. So that's why we are seeing a very huge injection of cash. But investors, I think, would feel very comfortable because banks are typically a highly leveraged business and low transparency. So that's why I think this crisis highlights the problem of investing in banking shares.
Louis, does a banking crisis, can you explain a little bit about the process, about how that transmits to the broader economy and impacts the broader economy, if it does at all?
Yeah, so, any time that we have turmoil in the financial sector, like at the moment, then there are two obvious channels via which it impacts the real economy. One is that, when banks have issues with their balance sheets, they need to tighten up their own operations, so they become less easy in terms of borrowing. Their credit and financial standards are getting tighter, so that means there's less credit available. That is one. And secondly, people read about it and they get worried, and they maybe don't buy that car because they worry about the economy. So the confidence starts to affect how people spend and even how businesses think about expansions and things like that.
And are there signs that this is now starting to affect the US economy? Do you see anything at all in the data that is suggesting an impact?
It's very early day. I'm eagerly awaiting the S&P PMI indices that will come out. I think it is at the very end of this week or early next week. Basically, for China, they'll come out, I think, the last day of the month. For most others, the first day of April. That should pick up some of that impact on confidence in the business sector. I think on the consumer side, I think there was some news that Citigroup strategists referred to some tentative evidence of Citigroup's credit card businesses that suggested that spending came down. I don't know. I just read that as a news item, and there are of course many factors feeding into that. So it may be early to say, but it's not impossible. Although I mean personally, I still wonder really whether the man on the street, how you say that in English, whether he really starts to become worried about Wall Street bankers, struggling. I don't know. No, honestly, I don't know. It's something that we need to watch.
Do you think this makes the likelihood of a recession in the US higher now? In line with my very last sentiment, I personally doubt it, but we need to see. I have a feeling that this is going to be relatively contained. It's a financial sector issue.
is this really going to make companies stop hiring people? Is this really going to rein in the wage increases that people are asking for in the US? I personally doubt it, but I may be wrong.
Alex, the problem with all of this is that banking, essentially, it's a big confidence trick, isn't it? Because you have banks who have short-term deposits that people want back on demand, and then they lend it out for 20, 30 years to fund people's mortgages and can't get it back. So the problem is when the confidence goes, as we saw with Credit Suisse, it can go very, very quickly. And I'm wondering, even with companies like Deutsche Bank, which are very strong, aren't they? They're profitable. They have strong capital adequacy ratios, good liquidity buffers. None of that really matters when depositors take flight. Is that going to be the problem? And is that what's going to link maybe Deutsche Bank with Credit Suisse, despite the German Chancellor saying they're very different?
Oh, I think, of course, if you think you are very pessimistic, actually, could be very bad because, as I've said, no banks can survive a very abrupt bank run. But I think we do have some insurance program to protect small depositors. And many banks actually have diversified funding source. So I think that probably would contain the crisis to a certain degree. And large bank actually, I think, would be in middle. Deutsche Bank probably would still be okay, I think. And but of course, the banking shares actually would still be bad because, as I've said, people know about the low transparency and high leverage nature of banking shares, and also because cocoa bond actually would be highly affected in this crisis. So banks actually has very little way to increase their Tier 1 capital. So a cut in dividend is very likely in the future. So that is also hurting the value of banking shares.
It's called a banking crisis, but it's not really a banking crisis, is it? It's a crisis caused by the Fed. They kept rates at zero for so long, and they printed $20 trillion to try and fix the last crisis, that it's not really surprising that when they then suddenly raise interest rates by 500 basis points in just over a year to fight inflation, that you get all this volatility. Isn't it the Fed the root cause of this?
But Peter,
you can also,
sorry, go ahead, Alex.
Yeah, you can also blame the bank for their aggressiveness in managing the balance sheets. Because as highlighted in the SVB case, they actually invested too much in treasuries. They thought they were safe, and they thought they could hold it to maturity. But with a very abrupt bank run, actually, they are running out of capital, and they need to liquidate with a loss. And
they didn't hedge their interest rate risk, did they?
Yeah, right. Yes.
Peter, I just wanted to add on what Alex said. Policymakers make all kinds of mistakes, but I'm not sure that you can blame this on the Fed or all other policymakers. You have worked yourself in the financial sector. These people are paid, right, to prepare for changes in the circumstances. Yes, there are a lot of negative side effects of a long period of low interest rates, but these people in the financial sector are paid very high remuneration in order to change to make sure that their balance sheet is robust when the circumstances change, and circumstances change. I think it's also a lot of people ask, isn't it crazy that they have not cut interest rates when the financial sector is struggling? Well, no, they have two different instruments, right? The Fed, the monetary authorities have two instruments for two purposes, two objectives. They use all those liquidity windows to deal with the outflows and the liquidity situation, even as they need to use their interest rate policy to fight that very serious battle, which is not over at all, the battle against inflation.
So do they keep on raising interest rates to fight inflation? Or does this create a dilemma for them in that can they do both? Can they sort of stabilize the markets in the face of what's going on with the banks and at the same time fight inflation?
They can, yeah, they can. And so the on the question of will the next move be a raise or a cut, that will crucially depend on how much weakening of the real economy we're going to see. if there is no significant weakening of the real economy and inflation continues to power along, which it is doing at the moment in the US, when you look at core prices and how they are moving from month to month, if there is no significant weakening in the economy, then they will have to raise them again. And we are quite impressed by, surprised by how the market is now pricing in these interest rate cuts. For the market to be right about that, the market has to believe that we're going to see a very dire economic situation in the coming quarters in the US.
Alex, what do you think? Have the markets got it wrong here? They're pricing in now 100 basis points of rate cuts by the end of the year. Do you think that's likely?
Oh, I think it's not too likely because inflation actually is not contained, and I think these rate cut expectations actually has boosted the asset prices again. So that actually would make it a little bit difficult to see rate cuts, and actually banks probably would be a little bit contained in the lending. So I think that would already produce some impact on the economy side. So I think they do not need to do the aggressive rate cuts by the end of this year.
This is a bit of an odd banking crisis because if you look at the markets. If you look at the S&P 500, it was actually up for the week. The regional banking index was up as well. In Europe, the Stock 600 banking index was down a little bit, but not much. So if you looked at these things, you would have thought there's nothing wrong. It's a bit bizarre, isn't it?
Oh, yeah. Because I think, first of all, people are discounting a rate cut soon. So that is a supportive for the market, except banking shares. And then we have the AI boom in the technology sectors. And people actually like the mega tech companies because they treat them like treasuries. They think Apple is very solid with a very strong balance sheet and cash flow. Mm-hmm. It is even better than the U.S. government, I think. So that's why we are seeing strength in certain sectors and supporting the whole market. But as I've said, I think the banking sector would be devalued permanently. So we are probably seeing funds coming outflow from one sector. And probably we may see pressures in the resources sectors as well. But technology probably would keep the market afloat.
Yeah, I was looking at the New York Stock Exchange FANG index. It's up over 33% now just for this quarter. And then you've got Nvidia up 83.5% in the quarter, Meta up 71%. Enormous moves, aren't they?
Oh yeah, because I think we have seen a renewal of expectations that the rate hike cycle is coming to an end. And even we may start a rate cut cycle. So that is, I think, why we are seeing a boost in the asset prices.
Louis, when you look at the bond markets, the volatility in the bond markets right now is just enormous. We've had 11 straight trading days where the two-year Treasury yield has moved more than 10 basis points. We haven't seen anything like that since the beginning of the 1980s. But I'm wondering if there's any sort of warning signal we should be taking from the bond markets.
Yeah, people often look at the yield curve, right? And whenever you see it having a negative slope, the old age, the conceived wisdom is then that is heralding a recession, or at least significant economic weakness, the kind of weakness that would lead the authorities to lower the short-term policy rate. It's hard to say where exactly we are on the policy rate now compared to the peak. It's probably reasonable to say that interest rates in 2.5 years' time will be lower than where they are now. So there is logic, right, to the negative yield slope. What the story will be for the real economy underneath that will be the big question in the coming quarters. But it's not so bizarre to see a negatively sloped yield curve. And of course, as you said, it is the volatility that has been amazing, and that is probably not over yet either, as these expectations on what the current conditions mean for policy rates, as those expectations keep on bumping around.
What does this mean, Louis, for China's economic outlook? Over the weekend, Han Wengshu, deputy head of the Communist Party's Office for Financial and Economic Affairs, said the economic recovery is not solid enough. And then we also had the head of the IMF talking about China at the over the weekend at the China Development Forum in Beijing. And now she forecasts China's economy to grow 5.2% this year, driven by a rebound in private consumption. Where are we? Are you seeing, we're going to get the PMI data, aren't we, later this week from China, but are you seeing signs that the economy is recovering as the country reopens?
Yeah, I think we have pretty good signs from the high frequency indicators, all these indicators that we have on mobility, in subways, on the road, but also on things like housing sales. It's quite remarkable how the housing sector seems to have bottomed out. More generally, on the production side, steel in the steel sector. So we have quite a decent picture. Of course, the data for the first 2 months was also quite reasonable. So I think it's it is not at all it's not at all a wild guess to say that China's recovery is on track, and that will that will help this region. I think that China's recovery for most other economies will not offset the slowdown in the West, not completely, but it will definitely dampen the impact of that global slowdown.
The new government in Beijing clearly prefers certain sectors in the economy, doesn't it? Like consumption, tech, green, the green economy, healthcare, and so on. Do you think now China, it seems to be trying to set up more sort of centralized control over the economy. Do you think it's got the tools to be able to boost those preferred sectors?
Well, as you know, like industrial policy is nowadays totally accepted, also in the West, and governments will continue to use industrial policy to steer capital and to prioritize and to subsidize certain sectors. You don't want to overdo it as a government. It's hard. It continues to be hard for the government to pick winners and losers. So at the end of the day, you need the private sector with you, and there are limits to the extent to which you can steer the private sector and the extent to which you can steer capital. So, when we see that in China they have doubled down on trying to stimulate high-tech sectors and other promising sectors, it doesn't seem to be unreasonable. It's kind of like along the lines of what other countries are doing. But you need to watch out, and as I said, like you need to make sure that at the end of the day you let businesses make the most important decisions, and they will have to also be accountable and bear the brunt of it. So you cannot go against business and against the market with this.
Alex, what are your thoughts about the market over here? We've seen the MSCI China Index give up all its gains now for the year, despite that economic confidence that Louis was just talking about. What are your thoughts going forward?
I think China is a polarized market. We have the private sectors and the SOE. Right now, we are seeing a retracement in the SOE sectors because the latest results are a little bit disappointing, and also we are seeing a cut in dividend by certain huge corporates. So that's why we are seeing a retracement in the SOE sectors, and we are seeing some rebound in the private sectors led by Tencent. So fairly likely, I think we may see a rebound in China shares going forward because private sectors actually accounted for larger shares of the index. So we may see some strength in the short term, but I think the real play would be the SOEs. I think they would still be raising dividend in the long term, and I think people probably would go for safer plays, and also they would think the role of SOE in the China economy actually would be bigger from now on. So I would see that China actually is having a bull market and bear market together. A bull market in SOE and a bear market in private enterprises. So we are likely to see the dynamics between these two markets for a while.
Are banks out here, are they immune from the turmoil in the West? I mean, we have seen the share price of HSBC, Standard Chartered, sort of decline on sort of sentiment issues, really. But are they generally immune?
I think they probably will still be devalued because, as I've said, after this crisis, bank would be more difficult to raise their Tier 1 capital. So we are likely to see a change in their dividend expectations for the long term. So that is a hurt in value, and that will going to hurt their value. So I think they probably will still be trading in a lower range. But of course, they will not be in a trouble. They will not be in deep trouble. So I think we probably will see their shares to trade lower. But that doesn't mean that the business actually would get bad. It would get bad. But I think that is the dividend expectations and the expectations that they would be more prudent in their lending. So I think that is hurting their business and profitability. So that is not related to their health, but that is related to profitability.
Okay, well, thank you both very much there for your thoughts. Great to hear you. You heard Alex Wong, who is director of Alex K.Y. Wong Asset Management, Louis Kuijs, who is chief Asia Economist at S&P Global Ratings.
You're listening to Peter Lewis's Money Talk.
I'm joined now by Ben Cavender, who is managing director at the China Market Research Group up in Shanghai. Very good morning, Ben.
Good morning.
Let me ask you, first of all, your thoughts on the banking crisis that we're seeing in the West. What do you think is behind it, and do you think it's been contained at all now?
Yeah, I think it's been a very interesting week and a half or so, speaking with a lot of companies that maybe had some exposure to SVB or investors that had previously been, very heavily invested into smaller regional banks in the U.S. I think a lot of the crisis is almost sort of self-manufactured maybe by some investors that were pointing at some of the problems that SVB had, even though, realistically they still had quite a nice balance sheet. They got put under pressure very quickly. That's now really had a knockdown effect of putting a lot of pressure on some smaller regional banks in the U.S. that maybe, weren't in quite as good a position. So I definitely think this is going to be a little bit of a drag on the startup world in the U.S., making it quite a bit more difficult maybe for smaller startups to get access to some of the funding they need. But overall, I don't think we're really looking at true systemic risk right now.
Are you surprised that the vultures are now circling banks like Deutsche Bank?
Yeah, it's really been interesting to see how this has unfolded and the kind of pressure that it's caused for some of these, quite large global banks. I think there's a sort of a degree of opportunism in play, but it has pointed out maybe that the way that some of these banks were structuring some of their investments and the way that they were parking some of the deposits that they had in place really maybe were not done as cleverly maybe as the bankers might have thought. I don't think that long term this is going to create huge problems, but I do think it's sort of created quite a bit of turmoil, certainly in the short term.
And what about out here in China? Is the banking model here different to the US and Europe, such that Chinese banks, Hong Kong banks are immune from contagion elsewhere?
I do think that there is some degree of there being a firewall in place, and I don't think that the banking crisis that we've seen in the U.S. and Europe is really directly going to put that much pressure on Chinese banks. But having said that, I do think that there is still a fair amount of risk within the Chinese banking system. I think if you look at the large state-owned banks, they're in overall quite a good position. They tend to be quite conservative, and I don't think there's going to be much pressure on them. But if you look at a lot of the smaller regional banks, it's still very much kind of wild west in the sense that you have still quite a bit of private ownership in these banks that's not potentially well documented, and that can create some conflicts of interest as far as how lending happens. And I think that's why you've seen the central government here really try to exert more control at the national level over what these banks can do. But that's a long way of saying that no, I think that China is sort of mostly isolated from what's happened in the U.S., but there is still some risk here. I think the bigger issue, though, is probably when you look at a lot of Chinese startups that maybe previously were looking at raising foreign capital outside of China through kind of interesting corporate structure, so variable interest entities, they have a problem now because it's going to be much harder following the SVB collapse for them to get access to that kind of funding. So what this is all leading to maybe is Chinese companies, again, really having to rely on, more and more of their fundraising and growth to happen within China. So again, sort of this decoupling of the Chinese economy from the global economy.
It seems to be the theme the world over, doesn't it? That it's the smaller regional banks that people are concerned about. That's true in the US. If you look in Germany, you have these Sparkassen, these thousands of little regional sort of banks. And we have it in China as well, don't we? Because there has been some various sort of financial problems. We had Baoshang Bank, the bankruptcy of that. Then we had the run on Henfeng Bank. So even in China, the smaller regional banks do seem to be having problems.
Yeah, it's definitely an issue here. I mean, this tradition of smaller regional banks in China having problems definitely goes back a couple of years, because you had large entities like HNA that had basically taken over smaller regional banks, essentially to their benefit, to make it much easier for them to borrow money and load up on debt. And so that's kind of been a persistent problem here. And I think the reality is that there is more and more oversight coming into play, and the central government talks a lot about how they're reducing systemic risk by having more oversight in place over the banks and also over, other types of sort of financial instruments that are being offered to investors here. But the reality is that on some level, it's still a little bit of a black box, and it's very hard for somebody to know how solvent or how safe an investment in one of these smaller local or regional players might be, because there just sometimes isn't that much information. So I think that there definitely still is risk within the banking sector here, though by and large it does tend to be more conservative probably than the US.
What about the big banks? Obviously, they're state-owned, so they're widely perceived to have the support of the governments, which isn't going to let them fail. But nevertheless, they've had problems of their own as well, haven't they? They're heavily exposed to large property developers, many of which have now defaulted on their loans. Is this problem contained?
Yeah, I mean, I think that for the most part, the problem is coming under control now. Though having said that, I think, sentiment in the sort of the real estate space here and what's happening with larger developers is still quite negative in China. When you look at what's happening with real estate investment here, it's still substantially down from where it was pre-COVID. And I think when you sort of do checks on corporate optimism, consumer optimism in that space, it's still quite negative. So I think yes, that does put some pressure on the large national banks. I think the big issue we're facing right now is we've had reserve rate cuts here, with the idea being that the government wanted to get more liquidity in the market, get more lending to smaller businesses. And that really just hasn't happened, because the large banks now are playing so conservative, because they've been worried about the bad press they've gotten, because they've been worried about their balance sheets a little bit. You're just not getting the actual lending needed to really help these sort of medium and smaller companies that are sort of perceived as being higher risk. And so that in turn makes it much more difficult, I think, for China to sort of hit its 5% growth target for the year, or that might be why the growth target has been sort of posted as being so conservative, when a lot of people were expecting maybe the government to be shooting a bit higher for 5.5% or 6% this year. So I think because of the risk, we're seeing maybe slower growth coming out of COVID than maybe a lot of the leaders here would have liked to have seen.
And one of the outcomes of the SVB collapse is that it's really hit venture capital fundraising, which in turn makes funding for startups difficult. You mentioned small businesses in China. Is this problem just going to make it worse now, that it's going to be harder for small companies to raise money?
Yeah, I think it is. It is creating a little bit of a winter for smaller companies right now. They don't really have a lot of great options in terms of where they can turn for capital at the moment. And unfortunately, coming out of a recession or a very uneven economy like we've seen due to COVID, it is going to be quite difficult for a lot of these smaller businesses to get the funding they need unless they are in sectors that have really sort of gotten the mandate from the state to say these sectors are sort of must-win areas where we need to see growth. So I think, for example, you'll see businesses that are maybe in biotech, for example, still getting preferential access to funding because the government will essentially go to investment funds and say, listen, you really need to support the sector. This is a priority for us. But I think for a lot of other players, it's going to be quite difficult right now to get the funding that they need to be able to grow or to maintain operations.
How do the local China markets perform through this turmoil? We've seen the MSCI China give up its gains now for the year. What's the outlook going forward?
Yeah, I mean, traditionally what has happened around the national meetings that we've just had is that the market sort of performs in a choppy manner prior to the meetings, and then usually the meetings give enough good signaling on the economy that you see kind of a bump afterwards. And I think that's what a lot of analysts maybe had expected this time around, and it just hasn't happened. We've had really quite poor performance following the meetings. And I think that's because there's still so much uncertainty about the strength of the economy. I think a lot of people were hoping maybe that there would be more signaling from the government about sort of large scale activity to boost consumer spending. And that just really hasn't happened. There also hasn't been a tremendous amount of support for the real estate sector either. And so the result of that is I think a lot of investors are looking to see maybe what future corporate earnings look like coming out of China, because they're looking to see a recovery in domestic consumption, which we just haven't seen so far yet. Consumer inflation is still, unlike in the rest of the world, incredibly low in China. Consumers are still being very conservative about how they spend, other than how they're spending on travel and sort of experiences where they are willing to open their wallets. But for buying stuff right now, the market is still really weak. Also, I think there's a lot of concern that export demand for Chinese products is also continuing to be weak right now. And so I think there isn't enough positive sentiment about the consumer side of things or global demand side of things to keep the market going in the right direction. And that's why we've seen the sell-off. And I would expect that probably the next couple of months, unless we see some really strong Chinese corporate earnings come out, are probably going to be quite choppy, and we're not going to see a lot of gains in the market.
Ben, thank you very much indeed. That's Ben Cavender, Managing Director at the China Market Research Group. Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves on my daily blog. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Asian fund management industry consultant Stuart Aldcroft, James Wong, Chief Executive Officer at Asia Securities, and our US economics correspondent, writer and broadcaster Barry Wood. Bye for now.
Money Talk